Hello, Andrew Faldy here with SMBU, showing you a chart of implied volatility on the S&P 500, the SPX index. And while most look at the VIX alone, we're looking here at multiple time frames and multiple expirations inside of the SPX options to kind of have a look at what the market is expecting and how options are being priced. So what I have is the four time frame volatility indexes across the top, and then I have them combined here together down lower. The brighter the line, the shorter term implied volatility is being looked at. So white is the weekly expiration cycle. The light blue line, the cyan colored, I believe it's called, is the VIX itself that most look at. This medium blue line is the 3-month options, and the dark blue line that you probably can hardly see there is the 6-month options. So you can see that when the market is more calm, that short-term implied volatility can drop much lower than the intermediate and longer-term implied volatility. And then as the market gets more volatile in the short term, a lot of selling pressure, a lot of bouncing around in large moves, short-term implied volatility can spike above long-term implied volatility. And so you can see back in August when we had the flash gap opening on the Monday, you can see that implied volatility really took off from there, stayed relatively high, and then it took quite a while for it to get back down into lower ranges. So my application here is I am predominantly a mid-term, intermediate-term options spread trader. And this market that has a lot of movement in it requires adjustments in management and controlling risk. So first of all, I have reduced size for several reasons that I have discussed in the past. The first is below the 200 moving average, the markets can tend to be more volatile during whatever duration that we could be under that level. So at that point I cut size, and then also as implied volatility rises, on multiple time frames, you can see that we are getting back into the upper 20s and above 30 in some cases. So that those levels are important to begin reducing total exposure, which is a little counterintuitive. Many options traders talk about having higher levels of implied volatility is good because it adds probability. That is very true, but the higher it gets, the more risk is being assigned to the overall market systemically. So back when volatility is calm, let me just go back here. We'll go back into last year. When volatility rises up into these levels, that's an opportunity to be selling implied volatility. When it drops down, it's maybe a little bit more risky to be selling implied volatility. But as the entire range increases to higher levels, what's happened in the past and what can happen again is that can accelerate as we find some type of short-term capitulation period. So reducing total exposure in overnight positions is very important, so that's something I'm doing. And then intraday, I'm using this elevated short-term implied volatility, so the weeklies in the front month. I'm using opportunistic entries to sell premium that offsets my directional risk for the more complex medium-term trades. So seeking for lower delta, lower total exposure directionally, bringing in premium from those shorter-term options while it's elevated, and trying to reduce total exposure for overnight holds, and then intraday opportunistic entries, which means when short-term spikes in the market, up or down, if I'm long with my monthly options position, then I can use short-term bounces in the market. Quick, easy ways to look at that are 1 and 5 minute charts, possibly using a channel, either price channels, Bollinger Bands, Keltner channel, doesn't matter, but looking for those upper bands to be tested, and those become those opportunistic entries for downside adjustments and downside hedging, either with short call side premium or long put premium, depending on the amount of adjustment that you need. So just a couple notes there. I will make this code available within TradeStation It's a very simple bit of code here. Let me go ahead and show it to you. All right. So you can see if you have TradeStation, all you have to do is make sure you have your symbol set up this way, that VXST is the first, and then insert VIX, VXV, and VXMT. And then this is the very short bit of code that it takes to create this indicator down here, which plots all of the time frames of implied volatility, which when separated look like they're very highly correlated. But when plotted on top of each other, you can see that there can be periods of time that they're quite different from one another. So that's all for today. If you have any questions, feel free to send me an email. It's afalde, F-A-L-D-E, @smbcap.com. Thanks.